Gold hit $3,500. It was fast, sharp, a little surreal, and then it pulled back. Some cheered, others panicked. Most just shrugged and moved on. But here's what the majority missed. That $3,500 price wasn't the end of a bull run. It was the start of something else entirely, a revaluation, not just of gold, but of what the financial system is worth, who controls it, and who is quietly leaving the party before the music stops. Let's take a look. A lot of people saw the price and asked, is this a bubble? But here's the better question. What's the message in this move? Because when gold explodes higher, it isn't reacting to growth, it's reacting to failure. It doesn't spike because the future looks brilliant, it spikes because the present looks unsustainable. Gold didn't spike because of price mechanics, it spiked because the architecture of the global economy is cracking under its own contradictions. This wasn't a rally driven by tech optimism or earnings surprises. It was a sudden repricing of safety, a global reassessment of trust. Gold didn't change, the system did. And when systems break, people wonder if they've missed their chance to act. Let's be honest, if someone's asking whether they're too late to profit from gold, they're already behind those who never needed to ask that in the first place. But the good news? No, it's not too late. In fact, this moment might be the most important opportunity to date in a decade. Because what's happening right now isn't a price event, it's a structural reset, a slow, awkward, silent abandonment of faith in the systems that were supposed to be immutable. To understand this moment, you have to understand what's actually behind the move. And it's not just inflation or market positioning. Let's start with the dollar. JP Morgan reckons it's 10 to 15% overvalued based on its long-term real exchange rate. Add in ballooning deficits, Fed interference, and tariffs as foreign policy, and you've got a global reserve currency looking more like an overstretched brand. And yet, central banks are watching, and they are reacting. Real yields supposed to kill gold, but in 2023, they soared, and gold still gained. In 2024, they stayed high, and gold still broke records. This isn't a fluke, it's a reappraisal. Trust, it turns out, is the rarest asset of all. And guess what? It's vanishing. There's no austerity, no credible policy, just printing, taxing, borrowing, and hoping. And when hope runs out, gold steps in. And when gold moves this violently, it's not just about fear. It's about panic at the top. You've probably heard this one before. Gold goes up when people are scared. But that kind of misses the point. People aren't scared. Governments are. Institutions are. Central banks are. And not in the twitchy, headline reactive way, in the we quietly dumped $1 trillion worth of paper for physical assets kind of way. This isn't about inflation. It's about institutional abdication. Gold didn't spike because people saw a bright future. It spiked because they saw no adults in the room. When the IMF, the very institution tasked with maintaining confidence in the global order, publishes papers that effectively says, we're screwed, well, that's not a sentiment, that's a thesis. The IMF's latest World Economic Outlook even admits it doesn't know what comes next. Growth is being revised down across the board. Trade policy is being weaponized. Alliances breaking. The playbook, it's outdated. And America is rerunning the 1930s tariff play. And here's a spoiler for you. It didn't end well the first time. So what do you do when the framework itself is breaking down? You hedge, not against volatility, against madness. That's the bit that no one says out loud. Gold isn't just protection against inflation or devaluation. It's protection from insanity, against a system that is run by algorithms, egos, and well-expired ideologies. It's against leaders who are simultaneously inflating bubbles and popping them. It's against a West whose central banks are politically captured and an East whose central banks are strategically predatory. And while everyone debates soft landings and CPI prints, the only thing priced in is uncertainty. Gold didn't suddenly become 16% more useful last month. What changed is belief, or rather the absence of it. In currencies, in central banks, in the ability of the system to even speak truthfully about what's happening. That's the bit people miss. Gold doesn't need to earn trust. Everything else needs to fight to keep it. And when the fighting starts, gold doesn't just join in. It stands still and it watches the rest fall apart. Meanwhile, the real smart money, the kind that doesn't tweet and it doesn't panic, keeps buying. Central banks have now bought well over 1,000 tons of gold every year for 3 years in a row. These are not retail traders. They're not hoping for a 10% move so they can sell into that strength. They're relocating long term, quietly, consistently. And in 2025, they're accelerating. More than 1/3 of reserve managers plan to increase their holdings, according to HSBC's latest reserve trend survey. And over 50% have already intervened in FX markets this year. And many are now treating gold as the last politically neutral asset in a world of increasing financial warfare. This is not a gold rush. It's a global hedge against policy, against politics, and against each other. And while gold plays its role, one character remains oddly quiet: silver. Historically, a real gold bull market is confirmed by two things: silver participation and a rally in the miners. And so far, we haven't really had much of either. The gold-silver ratio is hovering near 100 to 1, a level normally reserved for crises and panics. Mining equities remain subdued, and ETF inflows in silver are lukewarm. That's not a failure, that's a delay. Silver always lags until it doesn't, and when it moves, it tends to do it explosively. So if anything, silver's absence is a sign we're early, not too late. So yes, there was a pullback in gold. Commodity trading advisors had hit maximum long exposure. A $3,500 level was always going to provoke some rebalancing. But here's what didn't happen. Central banks didn't sell, ETF inflows didn't reverse, discretionary institutional investors didn't pile in either. This wasn't a blow-off top. It was a short-term clearing of froth, a reset of positioning. The long-term thesis remains firmly intact. There is something to be said for ownership that isn't digital first, that doesn't blink when the Wi-Fi drops. When gold's price spikes, so does market noise. But physical gold, it just sits there. It's still silent, it's untouched, it's outside the system. It doesn't need to outperform every year. It just needs to be there when everything else isn't. Physical is not about speculation, it's about sovereignty. And amid all this volatility, there's still one strategy that wins all the time: boring old dollar cost averaging. Buy the same amount each month. Ignore the noise. Accumulate over time. And when the price dips, you get more ounces. And when it rises, your holdings are worth more. You remove emotion, you build conviction. It's not sexy, but it works. And eventually, when you need it, you have something real. It's unhypothecated, it's undebased, it's uncancelled. And gold didn't spike because the new world discovered a new asset. It spiked because the world started to question the value of everything else. That $3,500 wasn't mania, it was a mirror, reflecting currency dilution, political dysfunction, economic denial, and the quiet, steady movement of wealth into something with no counterparty risk. No one rings the bell on a global reordering, but you can hear it in the silence. The central banks are buying quietly. The IMF is stuttering its forecasts. The G7 meetings that achieve nothing. The capital flight from dollar assets, the missing silver confirmation. The system isn't crashing. It's being silently exited. So no, it's not too late for you to buy gold. In fact, you might just be waking up in time because gold didn't peak. It just pulsed. And if you missed the signal, don't worry, it's going to ring again. Here's the part that most investors miss. Gold has always been the asset of the last resort when trust evaporates. But what we're seeing now isn't just a crisis of trust. It's the absence of leadership. And of course, we've kind of seen this before, sort of. In 1971, Nixon closed that gold window, and that just wasn't a monetary move. It was a global signal that fiat money would never be the same. Gold soared. In 1980, inflation spiraled. Gold hit new highs, but Paul Volcker stepped in, hiked rates, and restored credibility. A grown-up had entered the room. And in 2008, the system cracked. Gold surged again, but central banks flooded markets with liquidity, bailed out the banks, and kicked the can. And in 2025, there's no Volcker, There's no Bernanke. There's no Greenspan illusion. Just a deeply polarized political class, captured central banks, and a world where everyone is printing, everyone is posturing, and praying someone else fixes it first. This is the first global crisis without a credible adult in charge. Gold doesn't spike in times of hope. It spikes in times of vacuum. Now, this buying spree by central banks isn't business as usual. It's a mutiny, and the mutineers are sovereign. Central banks aren't just stacking for diversification. They're stacking to opt out, to build walls around their reserves. You look closely and you'll see the outlines of a different world forming, where gold backs trade, where currencies are local but trust is universal, where the dollar is tolerated, not trusted, and certainly not worshipped. Now, some countries are already bartering gold for oil, gold for grain, gold for quiet leverage. This isn't about hedging volatility, it's about replacing reliability, about insulating national treasuries from the chaos that they see coming from Washington, Brussels, and far beyond. This isn't just diversification, it's desertion. And retail? Well, they haven't even got started. Retail investors wait for pullbacks. They refresh charts. They ask whether $3,000 is overbought. They're still thinking in percentages, still believing the price matters more than the principle of owning gold. And here's the inconvenient truth. By the time gold feels like a safe buy, it'll be in the wrong place. Because when gold finally looks obvious, it'll also be scarce, locked down, repatriated, tokenized, gated behind premiums, restrictions, and excuses. And that's why central banks don't wait for the dip. They buy the risk-free asset before the risks show up in the headlines. So if you're wondering what to do now, don't ask what the price is doing. Ask what the system is telling you. Because it's not just telling you that gold is back. It's telling you that the old rules are gone. And if you're starting to realize that the system isn't going to fix itself, that this slow motion exit is happening with or without your permission, then now's the time to prepare. And we've even put together a free guide called the Exit Plan, designed to help you step off that merry-go-round and take control of your financial future. It's not about panic. It's about planning. It's about building something real while the rest of the world is still just pretending. So download the Exit Plan now, take a breath, and start your exit.